My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Are we coming out of the trough? I mean, that may sound like a crazy question when the averages are flirting with their all-time highs, even as the action ultimately turned negative today. Dow dipping 105 points, S&P declining 0.80, and the now beleaguered tech-laden NASDAQ plunging 1.69%. But for months, this market's been led by the COVID winners, the names that do just fine when the economy's frozen. Those are not the stocks that lead us higher when times are good, though. But as we saw today, the COVID plays can absolutely lead us lower when the economy's improving. So, are we finally emerging from the trough? Well, let's consider the case here. First, you need to know, we're in a dangerous place. It's dangerous to be where we are because you can never tell if the economy is really at an inflection point until after. And even if it is, the COVID stocks make up such a huge portion of the averages, as you know, say $14 trillion worth, they can drag down everything. We're now on the third day of this rotation out of the fastest growing COVID winners into the big uglies, the industrials, the financials, the travel, leisure, retail. These groups have struggled to find their footing because they're the COVID losers. But now, at least in the morning today, but the last 2 days, they're on fire. I mean, did they give up the ghost at the end of the day? I'm not so sure this time. Maybe these unloved stocks can escape the trough while the high flyers find themselves buried alive after a fabulous run. I mean, wouldn't it be something if you saw like Okta or Ping in here? Is that Ping? Ping? Oh, no, it's not Ping. Anyway, so is this yet another temporary rotation that will quickly flame out? Or are we really coming out of the trough and switching to recovery mode? With this kind of call, you cannot jump the gun. Many have tried, as we've had a series of 3-day rotations into the Caterpillars and the Boeings, and then they went right back down, and growth burst higher again after recharge. But sooner or later, we are going to turn the corner, and these moves, they will stick. It happens. It always happens. For months, we've been in pandemic mode. The stay-at-home stocks, from Zoom Video to Take-Two Interactive to McCormick, the Spice Company, to the cybersecurity plays, they've all been on fire. Same goes for the big six. And I'm talking about Facebook, Amazon, Apple, Netflix, Google, and Microsoft. These are all companies that happen to do better when you're stuck at home. And their stocks have monopolized the new high list, about 20% of the market. In many cases, getting the kind of valuations that we haven't seen since the faded dot-com era. Now, though, there are plenty of signs that we're leaving the trough, at least for the publicly traded companies that have been stuck there, the recovery plays. Now, this requires a real leap of faith because we've still got 10% unemployment, incredibly high. That's down from nearly 15% in the spring. So we're headed in the right direction. We have a horrific number of people who can't cover their rent, can't even put food on the table. But as we'll hear later, commercial rents are increasingly being paid. You have to remember, though, the stock market is not a reflection of the entire economy. It doesn't tell you how America's doing as a whole. It never has. We're not trading unemployment futures or hair salon options or boutique gym ETFs. We're trading stocks of medium to large-sized businesses. So what matters to big business? Well, COVID cases and deaths are both coming down, though from an alarmingly high level. The Russians claim they have a vaccine, though they haven't fully tested it. Doesn't matter. We know that a trustworthy vaccine is on the way. If you think we'll be in the clear 6 months from now, then you have to swap into the recovery stocks now. Because if you wait for the all clear, the actual all clear signal, I promise you'll be too late. And listen, I'm betting that it is the real trough. I suspect the cyclicals, industrials, and banks could lead us from here. Not the COVID stocks, although that doesn't mean they'll be destroyed. Why? Okay, what I'm going to do is I'm going to just walk you through this. I'm going to give you 12 tells that suggest this move's genuine, or at least more genuine than the other, because obviously by the collapse at the end of the day, you could say nothing matters, okay? I don't believe that. I'm not that cynical. Let me give you the underpinnings, all right? First, gold prices are plummeting. As long as gold was going higher, you had to keep the prospect of financial Armageddon on the table. Today's huge decline in the precious metal says maybe we're going to be fine. Second, interest rates are soaring. That's a textbook sign of either a stronger economy or a lot more government borrowing, like we get if Congress can pass another stimulus bill. One way or another, it's good news. Third, oil's been making a stand in the low 40s. That's where many producers in the Permian Basin can actually survive. It's also an important sign of stronger demand. We don't want a collapse of the Permian. Fourth, there's real demand for travel. It's surprising. Royal Caribbean reported an awful quarter. Their ships can't go anywhere. But the stock soared because they're getting a normal amount of reservations for next year's cruises. Once we get a vaccine, people are fine going on cruise ships again, which is huge after all the terrible COVID headlines this spring. The airlines are starting to see a pickup in traffic, too, admittedly, again, off a very small, low base. You can't wait until they're half filled, though. You have to get in ahead of the turn. And Marriott says the bottom has already been put in. Airbnb is going public, for heaven's sake. A sure sign that things have turned up. Fifth, the biggest shopping center owner, Federal Realty, which we will hear from later tonight, and the biggest shopping mall owner, Simon Properties, have seen major increases in rent payments month over month after a hideous period of deferrals and outright defaults. Not great in absolute terms, but certainly relatively better than where we were. Many of the things I'm talking about are relative versus absolute. Six, it looks like the autos, at least in Europe, are back. Today, PPG, giant chemical paint company, pre-announced a sharply better than expected number, driven by paint for high-end cars, particularly European. Anything that's good for cars is also good for DuPont, a stock we own for the Charitable Trust, which you can follow along by joining the ActionAlertsPlus.com club. I'll be talking about DuPont on our Thursday club call, which you might want to listen in on. Seventh, Boeing reported some heinous order numbers, and the stock went up anyway. And that is what a bottom tends to look like, although it was up much more during the day than at the close. It's also extremely bullish for Boeing suppliers like Honeywell and Raytheon. Remember, that's the old United Technologies. That brings us to the eighth tell. Honeywell caught an ugly downgrade today. Its stock rallied anyway. We also caught a negative 3M note. Now, this was really incredible. It said basically if the Democrats win, then this company's going to be in real trouble over groundwater pollution. But it didn't matter. 3M stock went higher anyway. Ninth, Caterpillar's last quarter was truly disappointing, and I couldn't think of a single reason to buy the stock. But others look at Cat as the sainted industrials, the one you have to reach for and hold for the fabled $10 in earnings power if the economy turns around. Sure enough, Caterpillar keeps climbing. 10th, the banks. A week ago, everybody was worried about J.P. Morgan's escalating bad loans. I was watching Brian Sullivan's show. This guy came on and said, listen, they're going to have to cut all their dividends. Well, that was not very, let's say, in keeping with what ultimately happened in the next week, because Wells Fargo was considered on the ropes, but not anymore. Goldman's been trading below book value, and people were just sick of owning Bank of America. Suddenly, though, this group has come alive, which suggests that the bad loans might run their course sooner than expected. And Jamie Dimon looks like he's got it going again at J.P. Morgan. 11 tells Nike. This thing's a fabulous bellwether for the whole apparel cohort. Yesterday, Foot Locker reported a much better than expected quarter. Nike roared in response. Then it spent most of the day going higher before giving up the ghost at the end of the session. Apparel's been in the doghouse for ages, but if Nike's back, that's a very big deal. You might want to look into that one, especially if it goes below 100. Finally, number 12 is freight. United Parcel put up an amazing number last week, which created some phenomenal pin action for FedEx, although they both got slammed today after nice openings. The rails have been rallying, too. They're very economically sensitive, and they continue to run today. Very important. The transports rarely lie. All right, now here's the huge question. If the recovery stocks are ready to make a comeback and the big technology names get hammered, can the market handle the switch without giving up the ghost entirely? Now, initially, it looked like the COVID plays could hang in there, but then they collapsed and took the averages down with them. Remember, the COVID winners have been able to lead us to incredibly lofty levels. We could be in a weird situation where an improving economy hurts the averages because these high flyers, the Shopifys, the NVIDIAs, are so now heavily weighted in the major indices, not to Apple, Microsoft. Either way, the bottom line is that you need to stick with what I call the barbell, meaning own some recovery stocks and some COVID stocks. But I do think it's time to lighten up on some of those COVID names and swap into more stocks that are like Honeywell and DuPont. Don't be greedy with the Cramer Covid-19 Index. As we get closer to slowing, not solving, but slowing the pandemic, it will be time to ring the register on at least some of the stocks that do better when COVID thrives.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.